All right, let's talk about the stock market. You know, when we think about it, we picture this big, open, fair playing field, right? Something like the New York Stock Exchange. But what if I told you that the market you see on TV is just the tip of the iceberg? Today, we're going to pull back the curtain and dive into the deep, hidden mechanics of how it all really works. This, right here, this quote is the key to understanding everything. The public market, the one that's lit up for everyone to see, is basically just the storefront. Behind it is this incredibly complex, maze-like system where the real action happens. It's not one big marketplace. It's a whole bunch of interconnected and sometimes very dark rooms. So you've got this perception that it's all fair, open, and democratic. But the reality? It's fragmented, it's often totally opaque, meaning you can't see what's going on, and it's built on these deep asymmetries where some people have huge advantages in information and especially speed. So let's peel back the first layer of this onion, shall we? Let's start with something we can all relate to, those commission-free trading apps on our phones, right? You see a stock you like, you pull up the app, and you tap buy. Simple. But what happens in the milliseconds after you tap that button is, well, it's probably not what you think. Let's follow the actual journey of that free trade. It seems like a pretty basic question, doesn't it? You click buy, and you probably assume your order zips right over to a public exchange, like the NYSE, to find a seller. I mean, that makes sense. But does it actually go there? The answer, almost all of the time, is a hard no. The real destination for your trade is decided by something called payment for order flow, or POF. This is the secret sauce behind commission-free trading. Here's the deal. Your broker isn't making money from you on commissions. They're making money by selling your order, your intention to buy or sell, to a massive wholesale firm. In this model, you're not really the customer. Your order flow is the product being sold. So let's walk through it. 1, you place your order. 2, your broker immediately sells that order to a wholesaler. 3, the wholesaler doesn't go to the open market. They just fill your order from their own massive inventory of stocks. And 4, they make their profit on the tiny difference between the buy and sell price, called the spread. The key thing to realize here is that this all happens off exchange. Your trade almost never touches the public market you see on the news. Now, this whole system creates a huge conflict of interest. Your broker has a legal duty to get you the best execution possible, but they're also getting paid to send your order to a specific wholesaler. So are they really sending it to the place that's best for you or to the one that pays them the most? That massive fine against Robinhood suggests it's often the latter. And get this, about 2/3 of all this PFOF money comes from encouraging retail traders to get into much, much riskier options trading. Okay, so that's the retail world. Now let's zoom out and step into the much larger and, frankly, much darker world of institutional trading. This is where things get really interesting. Just take a look at these numbers. Nearly a third of all U.S. stock trading happens completely off exchange, hidden from public view in places called dark pools. This isn't some small, niche part of the market. We're talking about a massive, parallel universe of trading operating completely in the shadows. So what in the world are dark pools? Well, think of them as private stock exchanges, usually run by the big banks. The original idea was actually pretty smart. Let's say a huge pension fund wants to sell 1 million shares of Apple. If they did that on the open market, everyone would see it, panic, and the price would crash before they could sell. Dark pools were created so they could do these huge trades anonymously without tipping their hand. They were supposed to be safe havens. But here's the great irony. These safe havens became the perfect hunting grounds. High-frequency trading firms, or HFTs, figured out ways to sniff out those big, hidden orders. They use strategies like pinging, sending thousands of tiny rapid-fire orders into the dark pool just to see what bites. Once they detect a giant order, they can literally race over to the public markets and trade ahead of it, profiting from the very price move the institution was trying to hide. And believe it or not, the exploitation wasn't just from outsiders. The very banks that ran these dark pools were caught with their hands in the cookie jar. ITG literally ran a secret trading desk to trade against its own customers, using their private data. Barclays and Credit Suisse told their clients they were protected from predatory traders while secretly selling them out. The fines, as you can see, were staggering, and they revealed this deep, systemic betrayal of trust. This takes us even deeper into the plumbing of the market, into the world of algorithmic warfare, where winning or losing is decided in microseconds, millions of a second. One of the main weapons in this war is called spoofing. The best way to think about it is like yelling fire in a crowded theater, just so you can get a better seat. An algorithm places a massive, but totally fake, sell order. That panics other traders, the price starts to drop, and then, poof, the spoofer cancels their fake order and scoops up the stock at the new, lower price. It is pure, high-speed deception. Layering is just spoofing on steroids. Instead of one big fake order, the algorithm places a whole bunch of fake orders at different prices. This creates a really convincing but totally false illusion of supply or demand, tricking everyone else's algorithms into making bad trades. And then you have, quote, stuffing. This is basically a denial of service attack on the stock market itself. An algorithm will just flood an exchange with millions of orders and then instantly cancel them, over and over. The goal isn't to trade, it's just to clog up the system's data feed, slowing down their competitors by a few crucial milliseconds. It's weaponizing information overload. Now, if you think this all sounds theoretical, let me tell you about the flash crash back in 2010. It was triggered, in part, by a single spoofer. In just a few minutes, all the high-speed algorithms saw the panic and just vanished. They pulled all their orders, all the market's liquidity disappeared, and the Dow went into an absolute free fall. $1 trillion of value gone. And then, just as quickly, the algorithms came back and the market snapped back up. It was a terrifying look at just how fragile this high-speed system really is. Okay, so now we're arriving at the deepest, most complex, and honestly most controversial layer of the market's hidden machinery, the problem of phantom shares and what's called the settlement system. This all starts with a practice that's flat out illegal, naked short selling. So in a normal legal short sale, you have to first borrow a share from someone before you can sell it. But with a naked short, you just sell a share you never borrowed, a share that might not even exist. This creates phantom shares, and it can be used to flood the market with fake supply to artificially drive a stock's price into the ground. So how do we know this actually happens? Well, the most famous recent example is GameStop. In 2021, the officially reported short interest in GameStop was over 140% of all the shares that existed. Just think about that for a second. How can you sell short more than 100% of a company's stock? It is mathematically impossible, unless, of course, a huge number of those shorted shares are phantoms. So how do they get away with this? Well, when you create a phantom share and fail to deliver it, a 13-day countdown clock starts before you get in trouble. To dodge this, they use a really complex loophole involving options. It's basically a fancy accounting trick that makes it look like they bought the share and delivered it, which resets the countdown clock. But in reality, the phantom share was never delivered. The can just gets kicked down the road, potentially forever. And hey, don't just take my word for it. The SEC itself has put out statements saying that these kinds of sham transactions, the ones that have no real economic purpose other than to get around the rules, are illegal. They violate federal securities laws. And yet the evidence suggests the practice continues. So let's just quickly recap the journey we just took. We started at the facade, right? The lit public market we all think we know. And then we went deeper and deeper, uncovering the hidden realities. Retail orders being sold through PFOF, giant institutions trading in dark pools, algorithms waging war in microseconds, and a settlement system that seems to be haunted by phantom shares. And that leaves us with this one huge fundamental question. The people who defend this system say all this complexity is a feature, that it creates liquidity and makes the market more efficient. But the critics say it's a bug, a massive one, that has created a rigged, two-tiered system that undermines fairness for everyone else. So what do you think? That's really the core debate about the strange and hidden structure of our markets today.